It's your show, John.
Okay. Hi, everybody. I'm John Arendt with Berkshire Hathaway. I've been the product manager for structured settlements since 2011. We have a ton of material to go through today, so I'm going to be brief. First off, we need to thank NSSTA for setting this up. We have this long list of topics that we've always wished we could present all at once to everybody, and we've never had a venue to do it before, so we're very thankful for that. We have a second goal today. We have a deep pool of talented, dedicated colleagues joining me. And you might not know them, or you might have only met them over the phone. And we want faces with names, and we want the opportunity for you to know who to call and why. We're going to go through about 8 topics today, and each of the people speaking will be subject matter experts on those topics. We're going to do it roughly in order of how a file hits the door and the life cycle of the file. We're going to start with Don Wurster, our president, and then we're going to do the sales team, and then we're going to hit our topics. So I'm going to come back at the end for my own topic. The chat feature in Zoom is enabled. Probably only the panelists can see the chat. So if you ask a question, it'll come to the panelists, but not the group. With that said, I want to turn it over to Don Wurster.
John asked me to be brief, which he knows me better, and he knows he wants to do that. I'm Don Wurster. My day job right now is I'm president of National Indemnity Company, and I'm also president of all the major insurance companies that you deal with, including Berkshire Hathaway Life Insurance Company of Nebraska, and First Berkshire Hathaway, and Columbia Insurance Company, and National Fire and Marine, and National Liability and Fire, and I get paid by the title, in case you were wondering. It's kind of a nice job. I started with Berkshire in 1982, and it was actually the structured settlement business that brought me to Berkshire. And I will tell you this quick story about how Berkshire actually sort of fell into the structured settlement business. And it has to do with Warren Buffett. He was reading an issue of Business Insurance in it was early 1982, and I think it might have been late 1981. And the article went into this newfangled sort of way of dealing with claimants, because there was always been a problem that claimants would get a lump sum, and then and Uncle Ernie would always have a great idea for starting a restaurant, and of course we all know what happens. It's 2 years later, basically the money's gone, and it didn't go where it was intended, and so the notion of structured settlements were introduced. And the structured settlement broker was explaining what a wonderful product this was, and actually named the company, which at that time, that company was National Fire and Marine, one of our companies. And unfortunately for that broker, actually described the life insurance company that had actually issued the annuity. And Warren immediately understood that in that case, there weren't assignments or anything like that. Warren immediately understood that he had a claims examiner who had actually made a long-term investment in a life insurance company that he wouldn't have taken a bet on for the next 2 years. And so he immediately put a stop to that. And then he did one further. He went to basically the person who was my mentor, the person who hired me into Berkshire, as well as the person who hired Jeanne into Berkshire Hathaway, Mike Goldberg. And he said, Mike, we want to be on the other side of this. We actually want to retain these liabilities, because this is exactly what we're built to do. We can manage long-term liabilities. And so I started in 1982, started what we called them periodic payments back then. And our plan was to do this in National Indemnity Company and in Columbia Insurance Company alone, because those were our property casualty companies, and we didn't have a life company then. And you need to understand something about what happened in the 80s, because I was responsible for the business then, among other things. I am a terrible marketing guy. And you're going to get a bunch of nodding heads saying, yep, we agree with that. Those who know me well know, one of the taglines in one of the bad Dirty Harry movies, not the first one was a good one, but it was like, you've got to know your limitations. And my limitations is I am absolutely terrible at marketing, and I'm terrible at sales. And so I was a failure. And so we basically did a few cases back in 1982 and going forward, but it wasn't really until the 90s when we got smart and started a life insurance company and had Bobby LeBlanc come on and start things and having John dabble a little bit and sort of understanding this, because John and I are the ones, the cerebral types, because we think about the business, and that's how we approach it. And it's a great business. And obviously, we finally figured out that in the end, and Mark John's, he's probably slightly better at me than marketing, but only slightly. So John and I both had that same limitation. So we were very smart to basically, hire people who were actually very good at this, which John was smart enough to be able to do. And I'll tell you one more thing about our policies and why this is an important business for me. I did go on to do other things, by the way. I didn't, they found another job for me to do around here, so it was okay. You don't need to worry about me. And I still think a lot about the liabilities that we're carrying, because everyone thinks about basically the placing of assets. I think about the liabilities, and one of the liabilities I think of is as follows: is that it is a virtual certainty for the contract that we have in place today that 100 years from now, at least one, and actually certainly more than one of those contracts will still be honored. And what you need to understand about that contract, it actually has my signature on it. So 100 years from now, absent, the worst, the mother of all viruses or global thermonuclear war, let's just set those aside for now because this is supposed to be a positive meeting. We are going to be honoring those contracts, and it's going to have my name on it. And the last thing in the world I ever want to do in the afterlife is to find out that somebody said, who is this guy that promised me this money 100 years ago, and why am I having troubles? And we are built to make sure that 100-year promise gets made. That's us. So now what I'm going to do is go to the positive part of the team, and that is turn it over to my friend Mal, who, by the way, needs absolutely no introduction. And so Mal, take it away.
Thank you, Don. And thank you, NSSTA, and especially Eric, Debbie, and Luann for your help and for giving us this opportunity today. During this very tough time we're all in, on behalf of our Berkshire team, we hope you're all okay, safe, and in good health. I really can't recall anything like this in my lifetime, but going back to the early 80s, I've seen our industry go through some very tough times. And I feel very confident structures will again come through this one and will soon flourish and be stronger than ever. Berkshire is a proud supporter of NSSTA. In addition to our financial support, Berkshire members have participated on several committees, including the Growth Committee, Legal, Education, and others. Berkshire's also supported me on NSSTA's board for 2 terms that ended in 2019. And thanks for that plug earlier, Eric, but I also have their support to run again this year, and hopefully I can count on your vote to be reelected to a 3rd term in the fall. Most recently, Berkshire provided NSSTA members with a favorable quote about structures from its chairman, Warren Buffett. The quote is now on the NSSTA website. Please feel free to use it when promoting structures with your clients. As Don mentioned, Berkshire's had a long history in structures, and it does go back to 1982. Our sales team and I became involved in 2011 while we were still at Symetra. In 2013, Berkshire officially hired the team. And since 2012, which was our first full year, through year-end 2019, Berkshire's had an amazing run, and we've led in market share with premium in excess of $10 billion. We have a very high average case size, and we've sold $1 billion for 7 consecutive years. Although we're proud of these achievements, even more so, we really appreciate and we're very thankful to the brokers and their teams who've supported us. Although this year, the business is very challenging for everyone, and we are certainly down from previous years, we continue to appreciate your efforts to support us. My career in the business has been with several life companies. Without a doubt, it's special to be part of Berkshire. some reasons why we've had good results and why this is a very special place to be. Number one is our people. The sales, legal, and home office teams all take pride in customer service. You'll be hearing from them shortly. Our niche pricing is long duration. That's where we're most competitive. The sales team is well situated geographically so that we have full-time coverage no matter what time zone you're in. Our guarantees make us very unique and we feel distinguishes us. John will discuss those shortly. Our brand is also unique and makes us an easy sell. We've been named as one of the most admired companies in the world by Fortune magazine for several years running. We are #1 most admired in the P&C category. But what I find more impressive in Fortune's listing of admired companies is the category that compares all corporations in addition to insurance. In that one, we're #5 this year overall behind the likes of Apple, Amazon, and Microsoft. And to be the only insurance company in the top 20 of this list, I think is really impressive. And as one of the most admired companies, this can only benefit you when discussing structures with your clients and makes Berkshire that easy to sell company. And last thing I want to talk about is our senior management involvement. In John Arendt, we have a leader with over 20 years of experience working at Berkshire. He's gained the reputation of being one of the most knowledgeable resources in the business. Having senior management's ear on the most complex and larger cases, John can provide exceptional turnaround that's helpful to you when you're crunched for time. I want to now introduce our most visible team with brokers and case managers, and that's our sales team. The team has virtually touched every single case we've sold since 2012. Because you know them well and time is limited, you'll hear more from others today. But we want Steve, Doug, and Patrick to at least take a bow, say hello, and give some background on how they got here. I'll now first turn it over to Steve Managini in West Hartford, Connecticut. Thanks all.
Thanks, Mal. Good afternoon and hope everyone's doing well. I'm Steve Managini. Just a little bit about myself. I started at Hartford Life in 2000, joining the institutional group, selling mutual funds to defined contribution plans. Funny story, in 2001, with my then boss at the time, Tony O, we were traveling, going out to dinner, interviewed this guy who I'd never heard of, Mal Diener, and that's how Mal and I met. In 2003, Mal hired me to the structured settlement team, taking over the Western Territory. In 2010, Hartford exited the business, and Mal and I joined Symetra with Doug Johnson. In 2012, we joined Berkshire Hathaway full-time, and the rest, as they say, is history. Please call if you have any questions. If I don't have the answer, I'll definitely be able to get it. We want to thank you for the business. We all appreciate it. And now I'd like to turn it over to Doug Johnson.
Thanks, Steve. Hello and good afternoon, everyone. I hope everyone is doing well and staying safe. Just a little introduction about myself. A lot of you I already know and have met, but for those of you who I have not met, my name is Doug Johnson, and I've been with the Berkshire Hathaway Structured Settlement sales team since 2012. I live and work from my home in Lynchburg, Virginia. My background in the business goes back to 1993 when I started with Federal Home Life out of Orlando, Florida. Later, I was with GE First Colony, which became Genworth. And after Genworth had left the marketplace in 2006, I stayed in the business working with Symetra, where I was later joined by Mal, Steve, and Patrick. I just want to say thank you all for your continued support, and more importantly, thank you for your business. Please enjoy the rest of the webinar, stay safe and stay well. And now I would like to turn it over to Patrick.
Hey, thanks, Doug. This is Patrick McNulty here, AKA the West Coast sales guy. Some may not recognize me because of my quarantine look. Anyway, I've been with the Berkshire sales team since 2012. I worked with the current sales team at both Symetra and in the move to Berkshire. During my time at Symetra, I worked in several different roles. I was originally hired by Symetra in the same hiring class as Mal and Steve, but was on the back office side of things for a year or so before moving on to project management. I was ultimately hired by Mal to be the third member of the Berkshire sales team with Doug and Steve. Mal needed a West Coast sales presence, so he flew in from New Jersey to Bellevue, Washington to offer me the opportunity. I gladly accepted. I finished out my remaining time with Symetra, moved on with the existing sales team to Berkshire, and moved my home office from Seattle to Los Angeles. I now work and live in Santa Monica. Thanks very much for all your support in business. Stay healthy and safe, everybody. We're here for you for whatever you need. Now I'd like to introduce our medical underwriter, Mark.
Thanks, Patrick. Appreciate the introduction, and greetings from British Columbia, Canada, making this really a truly international presentation today. I'm going to spend a few minutes talking with you about the importance of medical records and what we use in the market to give you the best possible rated age assessments. So just a little introduction. My name is Mark Koenig. I am the lead medical underwriter for Berkshire Hathaway structured settlement business. I've been in this role since spring of 2012, when at that time I was the chief underwriter for their retrocession life insurance group in Toronto, Canada. I have 26 years of life insurance experience, mainly spent in the reinsurance marketplace. I am a fellow of the Academy of Life Underwriting, a fellow of the Life Management Institute, and I hold a graduate degree from University of Kansas. So I want to talk about medical records. So what's the importance of the medical records? So other than the mildest cases, there's extra mortality and reduced life expectancy associated with many of the impairments we underwrite. The extent of the reduction is directly related to the overall functional loss of muscle motor skill and one's ability to care for themselves. You're going to hear me say that several times today because it's really important. So the two most important factors in a rated age assessment are how current are the records and the functional detail provided on the residual deficits of the injured person. When we don't have good medical detail or the records are old, we'll compensate for what we call this information risk by making conservative assumptions. So in general, the less information risk, the higher confidence in providing you a higher rated age. We often see records from the time of the event. Although this will give us some perspective, they are a point in time when the injury occurred, and often we need the benefit of time to understand how the injury is healed and the ultimate residual effects of that injury. This is true for most injuries. There are exceptions, and we'll talk about that later when we talk about a few impairments that we commonly see. I want to take some time to talk about current records. So the more current the records, the more confidence we have in our assessment, and we can provide you the best possible rated age. So duration from the time of injury is extremely important and is linked to the type of injury and associated time for recovery. And like I said, I'll provide some examples coming up. Specificity of records. So actual medical records are our best view into the functioning of the injured person. In some cases, we are only provided a life care plan, which can have a varying degree of information in the form of a medical history summary. As general guidance, we don't like to use this information as it's secondhand and can be subject to bias. The level of detail also varies greatly in these reports. Some are very high level and provide little to no information, and others are very good and give a very detailed summary. The latter allows us some opportunity to assess a rated age, but we'll take a more conservative view in comparison to actual medical records. So what do we look for in actual medical records? The record should address the impairments in question and provide functional detail we need to make the best possible assessment. So depending on the type of injury, the type of exam can be important. A physical exam, such as a neurological exam, provides detail on muscle motor functioning along with their physical abilities. A neuropsychologic exam deals with cognitive aspects of the injury and is very important in cases such as traumatic brain injury or other cognitive impairments. When there are both physical and cognitive impairments, we likely need both types of exams to make our best assessment. So the most important thing is to have medical information that directly relates to the impairment and the functioning of the person so we can provide you the best possible assessment on the case. I'm going to take a few minutes now to talk about a few impairments that we commonly see, and I'll start with cerebral palsy. So with cerebral palsy, the age at the time of review is a very important aspect of evaluating these cases. We use a functional assessment approach for our evaluations. So children that are under 2 have not had enough time to reach their functional outcome. And they will continue to see physical changes up to about 5 years. Now that's not a hard number. They do see changes after that. And so, but that's kind of the earmark that we use. Unfortunately, we don't often have that luxury of waiting for them to reach their 5th birthday. So we'll start underwriting children beginning at the age of 2, which requires us to make some assumptions of their future outcomes. This is why, I'll stress this, a current and complete exam after the age of 2 is really important. We can see kids that are 3, but then their exams are at 16 months. It doesn't do us a whole lot of good. When we do underwrite cerebral palsy, we take a bucket approach. So we have 6 impairments we look at, and we put those in buckets depending on the severity of those injuries. And the 6 buckets are: can they stand and walk? Can they roll and crawl? Can they sit? Can they support their head? How are they fed? G-tube, can they feed themselves, or do they have to be fed by others? And what's their cognitive ability? You know, by employing this bucket methodology, it allows us to assess what is a very complex set of risk factors and make consistent assessments out to the market. Second one I want to talk about is traumatic brain injuries. So improvements in function and recovery of traumatic brain injuries can be seen up to 2 years or longer after the accident, with the most improvement seen usually in the first year. A conservative approach to our assessment will be taken if the injury is within the first year, and we take a little bit more guarded approach if it's within the first 2 years. Again, we kind of use a functional assessment methodology with traumatic brain injuries, and we really focus on the extent of the injury, which is directly related to this term I'm going to talk about again: functional loss of muscle motor skills and one's ability to care for themselves. And the things we look at with traumatic brain injuries are the cognitive point, so their memory, executive function, emotional liability, things like that. Their muscle motor functioning, how they're fed, again, G-tube, or can they feed themselves? Can they make their own meals? And then their activities of daily living and instrumental activities of daily living. Third one I want to talk about is spinal cord injuries. So concerning spinal cord injuries, the single most important piece of information that we need is the level of the injury and how complete is the injury. When we have information showing a complete injury, we know it will be static, and we're able to make an assessment at that point in time. So this is the exception of the durational thing. A complete spinal cord injury is done at that point in time, and we can underwrite it. When we see terms in the meds such as contusion, bruise, or compression, we have to be more cautious and allow time to pass to better understand if there will be permanent damage or will the person recover. The last one I want to talk about is something we see quite often is pain syndromes. So a physical injury of this nature results in a chronic pain syndrome are common, and by no means does a standard rating from us indicate the person wasn't injured. However, we do consider pain to be an independent risk factor for extra mortality. We do not consider pain to be an independent risk factor for extra mortality. And again, the case needs to be assessed based on the injury and the extent that directly relates to the functional loss of their muscle motor skills and their ability to take care of themselves. Last thing I want to talk about is medical issues that are in the annuitant's control. So the Society Actuary studies show that even for standard lives, early excess mortality wears off as annuitants put time between themselves and the settlement. We think that over time, the initial stress of the lawsuit wears off and that annuitants engage in less risky behavior. We often come across highlighted information in the medical record such as smoking, build, drug use, suicidal attempt, or ideation. And sometimes we even get pushback as to why we're not rating these or the rating's not higher. This is very understandable, as these issues generally have excess mortality when viewed in the context of a large cohort, which is what I do in life insurance market every day. However, when you're considering someone as an individual, these risk factors are under their control, and the mortality assumptions do not work well in assessing an annuity. I'll give you a quick example, and I'll use smoking in the life insurance market. We generally know if you look at 1,000 smokers over time, there will be excess deaths related to smoking. So an additional premium is charged to cover that risk. If that person decides to quit smoking and can do so for 2 years, their mortality largely returns back to general population mortality. If requested, the insurance company will lower their premium to reflect that new mortality. With annuities, we don't have that luxury here. If a company rates a person up for smoking or other impairments that are within their control, they're obligated to continue that payment stream at the assessed rate, even if the mortality risk is no longer present. So, in conclusion, the best possible assessments are done on impairments that are static, and we have a good understanding of future outcomes. This is why current information and duration from the time of the accident are important in assessing the mortality risk. Although we do not cover all the impairments we typically see, these overall principles still hold when assessing mortality of an injured person. I'm now going to pass it off to Ray, who has a much more important topic to discuss, and that being your commissions. So thank you for your time.
Hi, I'm Ray Driessen. I'm the operations manager of our Omaha office. I've been with the Structured Settlements Unit for about 7 years. First thing I'd like to talk to you about, as he mentioned, is about how to get your commissions as fast as possible. We review and accept premiums daily. So to us, if we take money daily, it only makes sense that we're also going to pay daily as well. So commissions are reviewed and released every day. In April, we also began releasing commissions via direct deposit. What does this look like as far as turnaround for you? Presuming we have premium and all necessary documentation on Monday, the payment will likely be in the agency account on Thursday. This accounts for the fact that we receive premium generally in the afternoon when it is received in our department. And at that point, we then have to review it for acceptance, review the CSA, producer appointment, and then submit the commission for approval to myself or another member of our management team. Now, we routinely do all this and process the commission within 2 business days, with the commission arriving in your account on the 3rd business day. We truly believe no one processes and pays commission as fast as we do. In order to ensure your commissions are processed as fast as possible, it's important that the premium remittance form be completed and submitted with the premium. This is being done by most all of you quite consistently. Now of note, our premium remittance form captures some information for commission payment. On the form, we capture the producer names, the payee's state of residence, and we ask whether this is the sole producer or whether there's multiple producers. If you tell us on this form that there's only one sole producer, we're going to take you at your word, and we're going to release commission without any need for an invoice. If you tell us that there are multiple producers, we will not proceed until we have received that signed CSA. The number one thing delaying commissions today is producer appointment. If you lock a deal for a payee who resides in a state where you are not currently licensed, please seek out that license as soon as possible. That will help us ensure that there's no delay in paying your commissions. To recap, the required items to get paid: premium, premium remittance form, appointment, and when applicable, your CSA. Now, the next topic I want to discuss is our COVID signature policy. We have found 2 items to be our best fraud prevention tools: common sense and an actual physical signature for comparison. We are aware of other financial institutions using questions aimed at asking personal information only the payee would know. However, we do not believe these questions prevent the fraud from someone particularly close to that payee. A payee's mother likely knows what streets he's lived on, previous employers, and the makes and model of cars he's driven. For this reason, while we do use similar questions to qualify callers before discussing personal information, we do not believe this is sufficient to allow someone to make a change to a contract. Knowing the value of an actual physical signature for comparison, we have struggled to let go of this useful fraud prevention tool. That being said, we certainly all want to see the QAR signed as soon as possible. So as previously announced, we are temporarily willing to accept DocuSign signatures with the inclusion of the verification page, and we will consider other e-signature options as well during this pandemic. However, we want everyone to be aware that this will create some additional work for the payee to initiate a change request in the future, because we are going to then require that that change request have a notarized signature. For this reason, we are hoping to capture the actual physical signature on the QAR whenever possible for the payee's benefit. So now we aren't ready to answer e-signature questions for after the pandemic, but for the reasons stated here, we are currently anticipate that we are going to require the actual physical signature once the pandemic has ended. Next, to discuss address case to address case acceptance and underwriting, Jeanne Ragusa.
Thanks, Ray. Good afternoon, everyone. For my portion of the webinar, I want to spend a few minutes talking about our willingness to accept an assignment from a QSF and ensure you know that we require that all QSFs be evaluated prior to a case or quote being locked in, even if it's clearly multi-claimant and other markets have agreed to accept it. The evaluation process includes a review to ensure that the QSF is both multi-claimant and that there is a diversity of interest amongst the members of the QSF. In other words, the allocation amongst QSF members must still be undetermined at the time the QSF is funded. The documents we require for the review include, but are not limited to, the underlying release between the defendants and the claimants, wherein the defendant agrees to fund the QSF, both the petition and the order to establish the QSF, and the QSF trust document. We start with these documents and may request additional information based on our review. Here are a couple of examples where we may have agreed that the QSF was multi-claimant, but were not satisfied there was sufficient diversity of interest among the QSF claimants. Wrongful death. It is often the case that the distribution amongst members of the decedent's estate are determined by statute. For these cases, we would not be able to accept as there is no diversity of interest, which leaves open the possibility that the parties may have constructive receipt concerns. Having said that, we do understand that there are situations where the distribution amongst the wrongful death beneficiaries remains under dispute. For these cases, we may be more likely to be satisfied that there is sufficient diversity of interest. Another example would be a sub-QSF that has been funded from a master QSF. Many times, a group of claimants represented by a specific attorney will have their portion of the QSF funds placed into a sub-QSF funded by the master QSF. In this circumstance, we would likely decline to accept the assignment, as the allocation amongst these claimants would have to be determined by the master QSF administrator in order to allocate to the sub-QSF. Although I've spent some time discussing cases that are unlikely to qualify, we do in fact write a fair number of cases that have originated from a QSF. For these cases, we have developed a QSF-specific QAR and QARP that must be used. The primary difference in these versions of the assignment documents relates to paragraph 9, probably the most hated paragraph in our industry. As the QSF will be terminated once all the funds have been dispersed, there would no longer be an assignor to revert ownership to in the event this settlement agreement is terminated or Section 130 of the Code has not been satisfied. So instead of ownership reverting to assignor, it would revert to payee. So the next time you have a QSF that you'd like us to consider, please be sure to submit the request for our review to the general annuity mailbox, annuities@bhstructures.com. The request will be forwarded to the underwriter handling inquiries that day and will then be reviewed by both McKale Crawford and John R. I really appreciate your time today. And now we're going to hear from McKale.
Thank you, Jeanne, and thank you everyone for joining today. My name is McKale Crawford, and I am an attorney assigned to the Structured Settlement Unit full-time. Now, continuing from Jeanne's theme of case acceptance, we are often provided complaints followed by the question, will you accept this case as qualified? Surprisingly, the overwhelming majority of these requests can be separated into two categories of claims. The first type is where the plaintiff has alleged some type of underlying sexual touching or sexual misconduct. The second type is where the plaintiff alleges that they suffered extreme emotional distress as the result of witnessing a close family member suffer a fatal or severe injury due to the negligence of the defendant. This latter type of claim is known as negligent infliction of emotional distress, which also includes bystander claims and zone of danger claims that are specific to state law. To avoid getting tongue-tied, however, I'll refer to all of these as emotional distress claims. Now, with the understanding that we do not provide tax or legal advice and the parties must rely on their own advisors, we thought it might be helpful to provide some insight into how we review these claims. With respect to the sexual assault complaint, we first look for allegations that the plaintiff suffered some observable bodily harm as a result of the sexual assault. If no specific observable bodily harm is alleged, we look at whether the complaint makes an allegation of sexually invasive contact, and if so, we will presume a physical injury occurred. Finally, if the complaint makes a general allegation of non-invasive contact that involved harmful or offensive touching of a sexual nature causing some unspecified injury, depending on the particular allegations and the age of the plaintiff, we of course understand that the parties are much closer to the facts and circumstances of the case, and we therefore will generally defer to the party settlement agreement to characterize the damages. In particular, we would expect the settlement agreement to confirm that the payer intends to compensate the plaintiff for physical injuries arising out of the sexual misconduct. Now, the second most requested complaint review concerns negligent infliction of emotional distress claims. The question in this category of claims is whether the emotional distress has a sufficient link to the personal physical injury to qualify for an assignment. In 1996, when Congress added the physical component to Section 104A2, the legislative history reveals that Congress specifically contemplated that there are certain claims that will be deemed to have their origin in a personal physical injury, even though the recipient of the damages is not the actual physically injured person. The classic example of this, and actually the example cited in the legislative history, is a loss of consortium where one spouse recovers damages for a consortium claim as a result of the physical injuries to the other spouse. Although there is some tax court precedent suggesting that the physical manifestation of emotional distress can, in some cases, qualify for 104A2 treatment, we have little guidance as to whether the emotional distress claim itself will be deemed to have its origin in the physical injury of another person, like the loss of consortium example I referred to before. For this reason, we will generally leave to the parties to determine if the emotional distress claim has its origin in a physical injury, or if the parties believe there's a sufficient physical manifestation of emotional distress to qualify. To that end, we will defer to the settlement agreement to once again confirm that the defendant intends to pay as physical injury damages those amounts allocated to the emotional distress claim. Now, very important, when we do accept an assignment based on the intention of the parties, we want to stress that our QAR will still make clear that the parties are not acting on our advice. And like in any assignment, our agreement to enter into a QAR should not be viewed by the parties as guaranteeing any particular result or tax outcome. With that being said, it is worth mentioning that unlike the qualified assignment funded by an annuity, our reinsurance agreement does offer the feature that it can switch from non-taxable payments to taxable payments without triggering an actual ownership change of the funding asset. Now that I've given a little bit of background about case acceptance with two types of claims, I will now turn the webinar over to James, who will discuss some common pitfalls we see once the case enters our underwriting process.
Hi, I'm James Maakestad. My main role at Berkshire Hathaway is to underwrite the documents submitted for a case. There's a lot of material required, and we view those documents in their totality. I'd like to discuss some overlooked considerations that will slow down contract issuance. Okay, government proof of birth and birth certificates. Please make sure that you obtain and submit a government-issued proof of birth document as soon as possible. For minors, this is most likely going to mean a state-issued birth certificate. And this is an important requirement that frequently holds up issuance and may affect payments or payment dates if during the quoting process our sales team was provided with an errant date of birth. So obtaining and submitting a birth certificate at the beginning of the settlement process will avoid any future changes to payments, dates, required clarifications, or going back to the plaintiff for another document. Fiduciary payees. So this category of payee includes guardianships and conservatorships for the benefit of the claimant, and trusts, especially special needs trusts. Frequently, the parties will overlook that fiduciary payees may require extra documentation in order to receive annuity payments. For guardianships and conservatorships, we will review any appointment order and require letters of guardianship or conservatorship, which confirm the guardian or conservator has complied with the terms of the appointment order. And under most state law, fiduciaries are not fully appointed until the letters have issued. So special needs trusts, or I'll say SNTs for short, are approved by courts in minors cases. Sometimes the SNT approval will be a separate court order. In other cases, the settlement approval order will include an explicit statement of approval for the trust to receive payments. It's important to note that in some states, a minor's claim might not require court approval. However, we still require and expect to see court approval of the establishment of the trust unless it's unnecessary under a particular state's law. Now, it's important to consider the beneficiary designation for cases in which an SNT is a payee. Make sure the beneficiary designation language is carefully considered by the plaintiff. Please keep in mind, we would not mandate a specific beneficiary for an SNT that's payee, but when we see a less common scenario, we will confirm that if the measuring life dies, the beneficiary designation matches the party's expectations. More generally, outside the SNT context, when the claimant is a minor or incompetent and no trust is receiving payments, unless the court orders a specific beneficiary, we expect that the settlement language will default to the estate as beneficiary. This will permit the minor or incompetent to designate a beneficiary when they gain legal capacity. So, slide language. While we do accept slide language to address delays in funding, our slide language accommodates a 60-day delay instead of a 180-day delay. We will always want the final payment terms in the QAR or QARP, which sometimes will cause a delay in contract issuance. It's a good idea to reach out to us for prior approval when using the slide language in a settlement agreement, rather than just guessing at what we will or will not accommodate. Court approval of settlements. So, as you know, settlement approval orders vary widely depending upon the state-specific court and aspects of the case. If the parties do not want to list the periodic payments in an order, we ask for a specific reference to the exact title of the release, for example, settlement agreement and release, within the text of the order. We see this as a way to ensure the confidentiality of the payments in the release and confirmation that the court approved the terms of our exact lock-in. Sometimes we will need copies of other kinds of court orders. I mentioned fiduciary appointment and trust orders a moment ago. Other court orders we might need include a wrongful death approval order from a probate court, or a depository order when payments are needing to go to a specific bank or a restricted account. So, in all of this, in our document requirements, we want to maintain the win-win-win standard at the heart of structured settlements. 1, the defense should be fully released. 2, the plaintiff should receive their future payments without interruption. And 3, the assignor and annuity issuer should not be exposed to future liabilities or litigation that may arise from the unclear documentation. Now I'm going to turn the microphone over to Brennan Neville, who will talk a little bit about factoring. Thanks, everyone.
Thanks, James. I'm Brennan Neville, and I'm another attorney at Berkshire Hathaway. One of my responsibilities is to assist the company in protecting the interest of its payees who enter into factoring transactions, and thereby, effectively undo all the hard work that's put into creating a structured settlement. We receive notice of about 10 to 12 new factoring cases every week. As we all probably know, a factoring transaction has to be approved by a court based on the finding that it's in a payee's best interests. We receive notice as interested parties, and we frequently respond in these cases to provide the court with information to make these determinations. Occasionally, we actually oppose a transfer on legal grounds. For instance, we might do this if there are issues of residency or if there is suspected forum shopping going on. We also will object if a payee is trying to sell payments that they've already sold in a previous transaction, or if they're trying to sell the payments to multiple companies at the same time. In addition, we will often oppose attempts by a guardian to factor payments that are for the benefit of a minor. Sometimes, rather than objecting, we simply provide the court with information to make its determination. We provide information that the court might find useful in its determination if it's not disclosed in the petition. Some factors we might point out would include the date of the settlement agreement if the payee is selling payments from a brand new structure. We point out previous factoring transactions, previous attempts to factor that have been denied, and also we will advise the court of the terms that a payee might be able to get from our hardship exchange program if eligible, and I'll speak about that in just a moment. Most of the time our response is in the form of a written submission to the court. Occasionally, though, we send in local counsel to the hearing if there are unusual or difficult circumstances in the case. And from time to time, I will also go to a transfer hearing to present the company's position. Regardless of our involvement in the process, most factoring cases are approved by the court, no matter what the terms are. But sometimes the court will note our involvement and thank us for stepping up to the plate to give information. And sometimes a payee's or a factoring company improves the terms it offers to a payee, which is obviously for the best for them. I mentioned our hardship exchange program. We started this program in 2017 as a way of giving an option to our payees who may have liquidity needs due to some unforeseen financial difficulties. We created an internal factoring company that we call BIFCO to purchase payments from our payees in compliance with 5891 and state transfer acts. The terms that BIFCO uses are generally more favorable than a payee would get from an unaffiliated factoring company. When a payee comes to us and asks about getting money out of their structured settlement, we discourage this as any form of a quick fix or easy money. We remind the payee that when they structured their case, they made a smart decision to protect their future, and therefore we think the structured settlement should be protected as much as possible. We make this program an option of last resort, and we encourage payees to explore other options first. We don't have an internal checklist of reasons for which we will take a hardship case. We ask that the payee complete an application and provide documentation for us to consider, and our committee considers these on a case-by-case basis. We want to know why the payee wants money, of course, but we also want to help them solve their problems. And sometimes we just can't do that, and so we decline to take those cases. For example, payees often come to us saying that they need money to put a down payment on a house. If they want to use current payments to do this, we will probably decline that case unless there's evidence that they're going to be able to maintain the house, make their mortgage payment, pay taxes, etc. If they don't have another current source of income, that's unlikely. What we don't want to do is saddle a payee with a house they can't afford to live in and then take their future payments on top of that. Likewise, we will decline cases when a payee wants to use transfer proceeds to invest in a business opportunity, to undertake some sort of investment opportunity and the like. Those are cases we say no to. And given the number of payees that contact us wanting to get money now out of their structured settlement, we say no a lot more than we say yes. When we decline to take a case, we'll see that the payees frequently then go to a factoring company. We receive notice of these proposed transfers, and we respond to the court explaining why the payee didn't qualify for our program. That said, we will still tell the court we would reconsider this decision if the court thinks that a transfer on our terms is in the payee's best interests. Oftentimes, this causes the factoring company to improve its terms, which is a good deal for the payee. And if we do accept a case for a BIFCO hardship transfer transaction, we try to limit the size of the transaction to provide only enough money for the payee to resolve their situation and preserve the bulk of the structured settlement as much as possible. Most of our payees who receive monthly payments rely on them for their day-to-day support, and so we prefer to only purchase lump sum payments instead of these monthlies. And if we absolutely have to take the monthlies, we will do it, but again, only in a way that will keep them from digging themselves deeper into a hole. We started this program in 2017, and Jessica has been with us since its early days, and I'll turn it over to her. She's the first person to talk to our payees most of the time, and she would love to tell you about her experiences.
Thank you, Brennan, and good afternoon, everybody. We find that payees come to us after they have gone through the cash portion of their settlement faster than expected. Sometimes payees purchase a house beyond their means, and then they find they can't afford to maintain it. Also, many payees give money away to friends or family members in need. Sadly, they later tell us that those same people are unwilling to help them when it's them that need financial help. We often see factoring companies using questionable tactics to bring in business. For example, a payee shared with me that a factoring company told her her payments are at risk being with Berkshire. What if Berkshire declares bankruptcy? They told her that she can use the funds from the transfer however she wants, even if they stated differently in the filed transfer court documents. And they also falsely claim that we don't want payees to sell their payments because then we are losing money. In this particular case, the payee was convinced to sell partial monthly payments, even though that's her only stable source of income. And she was told that she could make up the lost income if she uses the proceeds from the transfer to buy a rental property. It's important to note that not all contracts issued with us are eligible for a hardship exchange, and sometimes they're not eligible for any type of transfer. Some payees that I've talked to are under the impression that they can get money back whenever they want. In reality, however, we can't offer a hardship exchange when the defendant owns the annuity or the law just doesn't permit payments to be transferred, such as workers' comp and medical set-aside payments. The last thing I'd like to talk about is our activity levels. Since our BIFCO program launched, we've taken over 1,000 calls from payees, some of whom call more than once. Usually, once they hear a story, they don't want to continue, but if they do, we'll send out an application to them. Of all the applications we've sent, less than half are returned to us. And of those that are returned, our committee has approved a little more than half with modification or as they are presented. All in all, BIFCO has taken 77 cases to court for a hearing, of which 75 were approved. Thank you for your time. I'm going to hand it over to John Arendt.
Thank you, Jessica. So when I was 17, my friend graduated from high school a year early and started college with an engineering degree. He told me how college was like putting his mouth over a fire hydrant and letting it flow and trying to drink. And I am afraid we did that to you today, and there was just a lot of information very fast. I do have one more topic for you, which is our guarantees. Our guarantees are an important part of the sales process, but they're also the feature, the product feature that stands behind our promise that we're going to be here for 100 years. Everybody in the structured settlement insurance business has a guarantee on their assignment company. Sometimes the guarantees come from a holding company. Most of the time, the guarantee comes from the annuity issuer themselves. When we set up in 1992 and 3, and we were re-entering the structured settlement business the first time with an assignment company and a life company, we wanted to do things differently. So the first thing we did was we named the life insurance company for Berkshire Hathaway, instilling trust. And that was a really big step for us. It was the first time a subsidiary had taken the Berkshire Hathaway name. The other thing we did was to design guarantees that we thought were more credible and superior to our competitors. So our normal guarantor is Columbia Insurance Company. Columbia Insurance Company is kind of a special company because it doesn't write all that much business, but it has a very strong balance sheet. It's got $20 billion of assets, or pardon me, $20 billion of surplus at Q1 of 2020. And its surplus makes up 81% of its assets. So if you compare it to other P&C carriers over the industry as a whole, after subtracting out Berkshire Hathaway, the surplus is 35% of assets as opposed to Columbia at 81% of assets. We also have a so-called dual guarantee, which was actually Steve Managini's brainchild. He pointed out, people are coming to us and they say you're the best credit risk, but your competitor, we need to split the deal with your competitor. The plaintiff attorney wants us to split the deal with your competitor so that we diversify our credit risk. So we said, we can diversify credit risk internally. On larger cases, so that we get a second bite of the apple, and generally these are cases with 3 million or more premium, we do offer a second guarantee from National Indemnity Company. National Indemnity Company is our flagship carrier. It's the largest P&C company in the United States. At Q1 of 2020, it had 130 billion of surplus. Interestingly, if you take all the life carriers involved in the structured settlement business and I'll add them all up, that's 64 billion of surplus. National Indemnity is more than twice of that. The dual guarantee is really interesting mathematically, which makes it better than a 50-50 split between two carriers. With the dual guarantee, if one carrier or if one guarantor or the other gets in trouble, the remaining guarantor just takes over and pays 100%. Obviously, with a split deal, if one of the life carriers gets in trouble, that portion of the settlement's impaired, and you may find yourself dealing with the guarantee funds. So, interestingly, I don't think we have any questions. If anybody wants to throw one out fast, now's your opportunity. If not, I do want to thank NSSTA again for setting this up for us. And we would have liked to add many, many more people to our Brady Bunch screen here and show off our home office even more. So since we really couldn't do that, what we will do is we'll bring many, many more people from the home office to NSSTA meetings to meet everybody. Okay, so we have a few comments, but no questions. We're getting some questions. Okay. Somebody asked, during COVID, how do we feel about having the documents signed at home with a cell phone photo of the documents? Ray can contradict me if I'm wrong, but I believe we'll accept a cell phone photo of a document. So you don't have to find a way to get the document into your office and onto a scanner. Somebody asked about plans to have an onshore assignee. An onshore assignee creates a tax drag on the transaction. We haven't played with that. Our non-qualified product, when it's reinsurable, and we can do it with a reinsurance product, does not create a tax drag. The other problem with onshore business that dissuades us from getting involved is that the durations tend to be short and we're just not competitive. Another question, are we planning on developing a more flexible commutation option? We are a couple weeks from releasing new underwriting guidelines. When we do release new underwriting guidelines, our pro rata, just enough to cover the lien commutation option, will be formally described therein. We've tried to describe that for many of you on a case-by-case basis. We do not think that an optional commutation works, unfortunately. With an optional commutation, our concern is that if the commutation's turned down, the payee might at that point have taken constructive receipt and entered into a second transaction. And the commutation value that we offered might become the basis in that second transaction, which is doubly hard on the payee, meaning not only is the interest taxable, but the interest is taxable from a lower base than what was built up in the contract. Let's see if we have others. Somebody asks us, are you comfortable being the only potential carrier to not accept a DocuSign ID QAR post-COVID? We will answer later what we're going to do post-COVID, But the thing to remember is our physical signature is our fraud prevention device. I shouldn't admit it, but I posed as my wife and got through the security questions 2 weeks ago on a financial website because I could remember the colors of the cars she drove when she was young. You know, we started dating very early. Fraud prevention is very important to us, and if we don't have that signed QAR, then at some point the payee is going to have to go find a notary. And finding a notary is going to be just as inconvenient as signing the QAR. So, you know, really they might as well sign the QAR. Somebody asked, do you market your factoring product to the annuitants? We consider it a factoring product. We consider it liquidity for people who do need help. We have not sent an annuitant a document in quite a while. When we first launched the hardship exchange, we did test pilot in 5 or 6 states and sent annuitants who we felt would qualify a short flyer. That flyer does exist on our website, but we are not sending it out. Somebody asks about our reinsurance product. Can it be used for taxable, non-taxable, or combined? And can we figure out how to do an exclusion ratio, say for disability policy buyouts? The short answer is yes, we can do any of the above with our reinsurance product. The nuisance is, of course, for it to be called reinsurance, we need the obligation to be funded by an insurance company. So the biggest shortfall with our reinsurance product is self-insurance. Give it like 20 seconds to see if another one comes in. Okay, I think we're going to wrap up. Thank you, everybody, for joining. I thank you all of my colleagues, the panelists, for putting up with me during the planning of this. Thank you, NSSTA, for providing the opportunity to us to have this presentation. And we're going to sign off now. Bye-bye.